Alright guys, welcome to Expansionary Monetary Policy. We're going to look at first in the short run. So there is a difference between the short run and the long run. So what we're looking at is if the Fed or the central bank were to conduct an expansionary monetary policy, what will be the result on the interest rate? First of all, in the short run. Now you notice, step out of the way here for you, there are three different models here. We have, starting over here, our money market model, then we have our loanable funds model, and then we have our good old friend, the aggregate supply, aggregate demand model. And what this really means is that they all three play a role in showing us what happens to expansionary monetary policy, both in the short run and also in the long run. So we do need all three models to answer this type of question. So this is really the first time that this is happening in this course. It's going to be pretty much the standard MO from here on out, where you're oftentimes going to need multiple models to answer one single question. But don't worry, it's not that bad, so don't get intimidated. We'll be okay. So let's start off with the easy part. Start off with what we know. Expansionary monetary policy. So what would the central bank do? Three options. Reserve requirement, they should decrease. The discount rate, they should decrease. And they should make an open market purchase of government treasuries. So those are their options, and that would be expansionary monetary policy. Remember, the goal of this is to get the economy moving more quickly. So what that will look like, we're going to start on our money market model, and that one's pretty basic. It's going to be the money supply curve shifting to the right. So again, make sure that we have everything correctly labeled. We have M1 and M2. At the bottom on our axis, we have MS1, MS2 up there. We show our arrow pointing to the right to show the rightward shift. Then we also, what we are particularly concerned with is what's happening to the interest rate. And we can see here, as we've done in previous videos to this point already, that when we have an increase in the money supply, it will lead to a decrease in interest rates. So we have a negative or inverse relationship between the money supply and interest rates. So like that. I know it's not perfect, but again, don't worry, it doesn't need to be perfect. I'm not worried about it. Now what you also probably notice is something that we haven't done yet. If you can see this, actually have our money market and our loanable funds model linked together, where they are both starting with their E1, the initial interest rate. They're both at about the same level. They're supposed to be perfect. I can't draw straight, so this is as good as you're going to get from me right now. The point of this, one of the points of this, is to show whether or not these two can be reconciled. Does the interest rate displayed by the loanable funds model reflect the same interest rate as the money market model? And our goal is to make those two be the same, because if they're not, then we're in trouble. So they started off equally. Both of them are R1, we have our interest rate there. So I have 6 steps that we're going to go through on this process. So I would highly recommend that you go through this as well, because again, this is not about memorizing shifts, it is about understanding the principles here. So, step 1, we have short-run expansionary monetary policy. Our first step is an increase in the money supply, or M. Alright, so we have increased the money supply. Again, if you need to write it out, I'm going to put just the variables, M for money supply. That leads to, we've already seen it, step 2, our interest rate fell. So I have a down arrow here, and R for interest rates. We don't use the letter I or IR to show interest rates. They are simply defined as R as our variable there. So we have an increase in M leads to a decrease in R in interest rates. So money supply up, interest rates down. Now, what component of GDP do interest rates most directly affect? So we have 4 options. Consumer spending, so C plus I plus G plus XN. Consumer spending, investment spending, government spending, or net exports. And the answer to that, which hopefully again we're familiar with by this point, is that interest rates most directly affect investment spending. They do also affect consumption, consumer spending, but most directly they affect investment spending. So the question next is, what happens to investment spending? Which way is it going to go? And the answer to that is that we know interest rates and investment spending are inversely related. So when interest rates go down, investment spending goes up. And if we don't remember exactly why, just think about it this way. The interest rate, well, let's think about what investment spending is. It's spending on physical capital and inventories. investing in a new business, in a new factory, things like that, usually business type of loans. The way that people pay for that, generally speaking, they're starting their business or expanding, they don't have the money to pay for that whole thing, so they have to borrow. So when the interest rates are low, people are encouraged to borrow more, which leads to more investment spending. Interest rates are high, they're discouraged from doing so, so it would decrease investment. So in this case, we have low interest rates, so investment spending will increase. Now we're going to skip over our loanable funds model because we're not yet ready to show what's happening there. But when that happens, when we have our higher investment spending, how does that affect our aggregate supply, aggregate demand model? Well, investment spending is one of our components of aggregate demand. We know that because we know that short-run aggregate supply is just basically inputs, wages, productivity. That's none of these. So aggregate demand is going to increase because of this increased investment spending. So aggregate demand increases, it shifts to the right. All right, so now we have, again, hope that you're doing this with me. We have E1, now we have E2. Now what we are really concerned with here is what happens to price level and to output. And you'll see why. So we have Y2, we have now increased output. P2, we have increased the price level. Okay? Now at the moment, now keep that in mind because that's going to be a huge factor when we start getting to the long run. For now, all I want us to put on step 4, so we have increased investment spending, and we're going to say for number 4, as a result of that, I'm going to put a few things on number 4. Increased AD, aggregate demand, and along with that, the one we care about is increased real GDP. And as you remember, hopefully our variable for that is Y. So we have higher output. Now the thing about Y, it doesn't just mean real GDP and it doesn't just mean output. It also means income. So when we have an increase in income, think about what you can do with your income. It can either be taxed, you can consume things, or, and this is the key one, you can save that money. So when we have an increase in income, we necessarily have an increase in consumption and savings. C for consumption, S for savings. And this S, that's going to be the important one for our loanable funds model. So step 4, which we have over here in our aggregate supply demand model, AD shifts right, increasing output and income, which increases consumer spending and savings both. Now, why does that matter? This goes back to our savings investment identity. Those two things are equal. Savings is equal to investment spending is equal to savings. Therefore, if S equals I, which it does, we go back to step 3, and what happened to investment spending? Well, investment spending went up. So when we have an increase in investment spending, it equals an increase in savings. And this is where our loanable funds model finally comes into play here. We remember that the supply of loanable funds curve is represented by savers and lenders. So what's going to happen here is that because our income has increased, S equals I, we have that the supply of loanable funds has increased. And in fact, what I would recommend you doing is link these beforehand. So we're going to do it something like this. And what we're going to see, if I draw it well enough, hopefully, is that we now have, as a result of this, our interest rates have become reconciled. Our supply of loanable funds has shifted to the right. I know this is a lot of information at one time. This is definitely a video that you might want to come, look at again because there is a lot to it, and it is very important. So I don't want to tell you that this is easy when it isn't. Definitely something you might want to take a look at again. But what we do see is that in the short run, we have a decrease in interest rates on both the money market model and the loanable funds model. Step 6 is just the last one, and it is that we have our supply of loanable funds shifts to the right. And so this is what an expansionary monetary policy in the short run looks like on all three of our models that we have gotten to so far. Hope this helps. Again, rewatch it if you need to. Next, look out for what happens in the long run. Till next time, see you guys. This has been a LaMoney production.